The Bank of Japan, BoJ, has decided to maintain its interest rate at 0.5%, while signaling a significant shift in its monetary policy by announcing plans to sell off exchange-traded funds, ETFs, and real estate investment trusts, REITs, acquired during its previous monetary easing efforts. This move marks a departure from its decade-long strategy aimed at stimulating the economy through increased liquidity and reduced capital costs to combat deflation and economic stagnation. The decision comes amidst political uncertainty and economic challenges, including a slowdown in inflation to 2.7% in August, down from 3.1% in July, largely attributed to a decrease in energy prices following the resumption of electricity and gas subsidies. The BoJ's announcement had immediate market repercussions, with the yen appreciating against the dollar, while the Nikkei 225 index experienced a decline of approximately 0.5%. Despite the impact of U.S. tariffs on Japanese exports, particularly in the auto sector, BoJ Governor Kazuo Ueda noted that these tariffs have not significantly affected broader economic indicators such as capital investment, employment, and wages. Analysts anticipate that the BoJ may continue to reduce stimulus measures, potentially announcing further rate hikes later this year or in early 2026, as inflation remains above the bank's 2% target. This policy shift reflects the BoJ's cautious approach to unwinding its extensive monetary support, balancing the need to manage inflation without stifling economic growth. The decision also coincides with domestic political changes, as the ruling Liberal Democratic Party prepares for a leadership election following Prime Minister Shigeru Ishiba's resignation, driven by voter dissatisfaction over rising rice prices. The BoJ's actions underscore its strategic recalibration in response to both domestic and international pressures, setting a precedent that may influence other central banks facing similar economic contexts.
The Goldman Sachs Group, NYSE, achieved a new 12-month high in its stock price, reaching $794 during Wednesday's trading session. This milestone follows a significant price target upgrade by Wells Fargo & Company, who raised their target from $785 to $855 and maintained an overweight rating on the stock. The upgrade reflects strong confidence in Goldman Sachs' financial performance and strategic positioning in the market. The stock closed at $792.89 with a trading volume of 140,302 shares, marking a notable increase from its previous close of $785.53. The investment bank's recent quarterly earnings report revealed robust results, with an earnings per share (EPS) of $10.91, surpassing analysts' expectations of $9.82. Revenue for the quarter was reported at $14.58 billion, a 14.5% increase compared to the same period last year. The company's return on equity stood at 14.32%, showcasing its effective capital utilization. Furthermore, Goldman Sachs announced a substantial increase in its quarterly dividend from $3 to $4 per share, reflecting a strong commitment to returning value to shareholders. With an annualized yield of 2.0%, institutional investors continue to show strong interest in Goldman Sachs, with 71.21% of the stock currently held by such entities. Recent transactions include significant share acquisitions by Seven Bridge Financial Group LLC and Osaic Holdings Inc., indicating sustained confidence in the company's growth prospects. The stock's recent performance and analyst upgrades suggest positive market sentiment, potentially driving further investment and influencing the broader financial services sector.
Uber Technologies, NYSE Uber, experienced a 4.9% drop in its stock price following notable insider selling activity. CEO Dara Khosrowshahi sold 300,000 shares at an average price of $95.37, totaling approximately $28.6 million. This transaction led to a significant increase in trading volume, more than doubling the average session volume. The insider sale has likely contributed to investor concerns, impacting market sentiment and resulting in the stock's decline. Despite the sell-off, Uber maintains a substantial market cap of $197.26 billion and has shown strong financial performance, with a recent quarterly revenue increase of 18.2% year-over-year. Analysts have mixed views on Uber's stock, with recent reports reflecting adjustments in price targets. Canaccord Genuity Group, downgraded its price target from $90 to $84, maintaining a hold rating, while Cantor Fitzgerald upgraded its target from $96 to $106, keeping an overweight stance. UBS Group and KeyCorp have also increased their price targets, indicating a generally positive outlook for Uber. The stock holds an average rating of moderate buy and an average target price of $103.06, reflecting a cautiously optimistic sentiment among analysts despite the recent insider selling. The company's strong return on equity and net margin further underscore its robust financial health, potentially mitigating concerns over leadership's share divestment.
Netflix Nasdaq NFLX has received an upgrade from Loop Capital, shifting its rating from hold to buy with a new price target of $1,350, up from $1,150. This adjustment suggests a potential upside of 11.78% from its current trading price of $1,207.78. This upgrade aligns with positive sentiments from other analysts, as Netflix maintains an average rating of moderate buy and an average price target of $1,328.87, according to MarketBeat. The company's recent financial performance supports this optimism, with a reported Q2 earnings per share (EPS) of $7.19, surpassing the consensus estimate of $7.07, and a 15.9% year-over-year revenue increase to $11.08 billion. The market's response to Netflix's robust financial health is evident in the stock's performance and institutional investor activity. The company's market capitalization stands at $513.22 billion, with a price-to-earnings (PE) ratio of 51.46, indicating strong investor confidence in its growth prospects. Despite a slight dip of 1.7% in share price, analysts forecast an EPS of 24.58 for the current year, reflecting ongoing confidence in Netflix's strategic direction and market position. Notably, insider trading activity has seen significant stock sales from key executives, including CFO Spencer Newman and Director Reed Hastings, potentially indicating a strategic rebalancing of personal portfolios amidst the company's strong market performance. Overall, Netflix's upgrade by Loop Capital signifies continued investor confidence, bolstered by strong financial results and positive industry sentiment. With a solid market position and strategic focus on expanding its content offerings, Netflix remains a key player in the entertainment sector, attracting substantial institutional investment and maintaining a favorable outlook among analysts.
Zillow Group Nasdaq (Z) recently reached a new 52-week high after receiving an analyst upgrade from Sanford C. Bernstein, which shifted its rating from market perform to outperform with a price target of $105. The stock traded as high as $93.45, closing at $91.24, reflecting investor optimism following the upgrade. The positive sentiment was further supported by recent analyst actions, including J.P. Morgan Chase & Company raising their price target to $94 with an overweight rating. The consensus rating for Zillow stands at moderate buy, with a price target of $90.38 based on data from MarketBeat. Insider trading activities have been notable, with significant sales from COO Jun Chu and CFO Jeremy Hoffman, reflecting a reduction in their respective holdings. Despite these insider sales, institutional investors have shown confidence in Zillow's prospects, with entities like L1 Capital Thai Limited and Canada Life Assurance County increasing their stakes. Institutional ownership accounts for 71.01% of the company, indicating strong backing from large investors. Zillow's market cap is $21.80 billion, and its stock is characterized by a high beta of 2.04, suggesting greater volatility compared to the broader market. The company's diverse offerings in real estate and mortgage services continue to attract investor interest, contributing to its recent stock performance.
VTEX, NYSE VTEX, has been upgraded by Jefferies Financial Group from a hold to a buy rating, indicating a positive shift in market sentiment towards the company. Jefferies has set a price target of $6.50, suggesting a potential upside of over 40% from the current trading price of $4.64. This upgrade comes amid a mixed landscape of analyst opinions, with J.P. Morgan Chase maintaining a neutral stance at a lower price target of $6, while Citigroup and UBS Group have both issued buy ratings with higher price objectives of $10 and $8, respectively. The consensus among analysts is a moderate buy, with a price target averaging $7.63. VTEX's recent financial performance shows a stable outlook, with the company reporting earnings per share, EPS, of 2 cents for the last quarter, meeting analyst expectations. Despite this, the company's revenue of $58.80 million fell short of the anticipated $60.35 million. VTEX, a provider of software-as-a-service digital commerce platforms, has a strong market presence, with institutional investors holding a significant 63.69% of its shares. The company's strategic focus on enabling enterprise brands and retailers to build online stores and manage orders across channels positions it well in the growing digital commerce space. However, the stock's high price-to-earnings ratio of 58.01 and a beta of 1.31 indicate potential volatility and valuation concerns, which investors should consider.
Perion Network Limited, Nasdaq Peri, has experienced a substantial increase in short interest, with shares sold short rising by 35% from August 15th to August 31st, totaling 707,900 shares. This increase suggests a growing bearish sentiment among investors regarding the company's stock performance. The short interest ratio, which indicates the number of days it would take for short sellers to cover their positions based on average daily trading volumes, stands at 2.2 days. Despite this, institutional investors have shown confidence in Perion Network, with significant increases in holdings reported by entities such as BNP Paribas Financial Markets and Point72 Asset Management. Analyst sentiment towards Perion Network remains cautiously optimistic, with a consensus rating of moderate buy. Recent upgrades by research firms, including Lake Street Capital and Wall Street Zen, reflect positive expectations for the company's future performance. The stock is currently trading at $9.80, with a market capitalization of approximately $439.33 million. The company's P/E ratio is notably negative, at -81.67, indicating that it is not currently profitable, while its PEG ratio of 0.84 suggests potential undervaluation relative to its growth prospects. Overall, the mixed signals from short interest and institutional activity, combined with positive analyst ratings, paint a complex picture for investors considering Perion Network stock.
KeyCorp has reduced its price target for Crown Castle Inc., NYSE CCI, from $125 to $120, despite maintaining an overweight rating on the stock. This adjustment reflects a potential upside of 29% from Crown Castle's current trading price of $93.02. The real estate investment trust, REIT, known for its extensive portfolio of over 40,000 cell towers and 90,000 miles of fiber infrastructure, has seen mixed reactions from analysts. While some, like Wall Street Zen, have upgraded the stock from sell to hold, others, including Royal Bank of Canada and Raymond James Financial, have either slightly increased their price targets or maintained strong buy ratings. Crown Castle's recent financial performance showed a slight beat in earnings per share, EPS, at $1.02 against the expected $1, with quarterly revenue of $1.06 billion, surpassing the consensus estimate of $1.04 billion. However, the company reported a significant year-over-year revenue decline of 4.2% and a negative net margin of 85.54%. Despite these challenges, institutional investors continue to show interest, with several increasing their stakes in the company. The ongoing investments and analyst ratings suggest a cautious optimism towards Crown Castle's future performance, with a consensus price target of $116.18 and a moderate buy rating, indicating potential for recovery and growth in the communications infrastructure sector.
Merck & Company, Inc., NYSE MRK, experienced a notable downgrade from Berenberg Bank, shifting its rating from buy to hold with a revised price target of $90, down from $100. This adjustment reflects a potential upside of 10.29% from Merck's previous closing price. The downgrade follows similar actions by other financial institutions such as Wells Fargo, which also reduced its price target to $90, and Cantor Fitzgerald, which shifted its rating to cautious. The consensus among analysts is a hold rating with an average target price of $106.41, indicating a mixed sentiment in the market regarding Merck's future performance. Merck's current trading metrics show a market capitalization of $203.82 billion and a P/E ratio of 12.57, suggesting a relatively low valuation compared to its earnings. Despite the downgrades, Merck reported strong quarterly earnings, with an EPS of $2.13, surpassing consensus estimates, and revenues of $15.81 billion. The company maintains robust financial health with a current ratio of 1.42 and a net margin of 25.79%. Institutional investors continue to show interest, with 76.07% of the stock held by such entities, indicating ongoing confidence in Merck's long-term prospects despite short-term rating adjustments.
Sri Lanka is advancing its electricity sector reforms with a focus on tariff methodology, aiming to balance financial viability, sustainability, and consumer protection. The discussions, aligned with the IMF's Extended Fund Facility (EEF) program, highlighted the importance of cost recovery and cost reflectiveness in creating a transparent and efficient electricity market. Led by IMF senior economist Delphine Pratty, the talks involved key stakeholders including the Committee on Public Finance and the Ceylon Electricity Board, CEB. The reform is a prerequisite for continued support under the EEF program, with a deadline set for November 2025. The discussions emphasize the necessity of aligning tariffs with actual service costs to eliminate inefficiencies and attract investment. Achieving Sri Lanka's renewable energy target of 70% by 2030 was a focal point, requiring significant investment in solar, hydro, and wind energy infrastructure. The volatility of thermal power costs, susceptible to global price shocks, underscored the need for a predictable tariff structure to protect consumers and ensure financial stability. The reform also calls for improved governance and regulatory independence to enhance data integrity and transparency, addressing current gaps in power purchase agreements and cost breakdowns. This comprehensive approach aims to deliver a financially viable power sector while safeguarding vulnerable households and promoting fair outcomes for all stakeholders.